Most people think commodities are only for big Wall Street traders or day traders looking for fast money. But in this video, you'll see exactly how commodities hedge against inflation, how you can get exposure with small amounts of money, and the simple risks you need to watch. When we say commodities, we mean standardized raw materials used in production. Think oil, wheat, copper, or gold. These are everyday building blocks, not just abstract trading instruments. Every gallon of gas you buy, every ounce of coffee you drink, and every piece of gold jewelry you see all tie back to commodities, and they might be the most misunderstood asset in investing. The surprising part, commodities aren't just aggressive plays. They can actually protect your money during inflation and balance your portfolio when stocks crash. Once you see how they really work, you'll understand how they can change the way you think about risk and inflation. Drop one commodity you're curious about in the comments, and let's clear up why so many people still see them as something exotic or risky. But first, this video is for informational purposes only and is not financial advice. I'm not a licensed financial advisor. You should do your own research and consult with a qualified professional before making any financial decisions. Hey, welcome to the Trading and Investing Hub. I'm Alex, and today we're talking about investing in commodities. Commodities are often treated as exotic or something only professionals should touch, but the reality is far simpler. They're the raw materials that power daily life. Oil isn't just a line on a trading screen, it's what fuels transportation. Wheat isn't just a futures contract, it's what goes into the bread on your table. And metals aren't just numbers in a spreadsheet, they're inside your phone and laptop, making them function at all. Despite being so basic and essential, commodities still carry a reputation as risky or overly complex, which is why they remain one of the most misunderstood asset classes in finance. Here's where the misunderstanding gets sharper. Commodities sit at the center of the global economy, yet investors often treat them like a sideshow to stocks and bonds. Take gasoline prices. For consumers, higher pump prices immediately cut into everyday budgets. But for producers and energy-linked companies, those same higher crude oil prices can mean higher revenue. At the same time, industries that rely on shipping or manufacturing face rising costs. What looks like one event unfolds in multiple directions, penalizing consumers broadly, benefiting some firms, and squeezing others. That tension between harm and opportunity is what makes commodities so different from other asset classes. Think about it through a simple analogy: baking bread without flour. No matter how perfect your recipe, nothing happens without that first ingredient. Commodities play that foundational role in the economy. Oil powers factories and trucks, grains feed global populations, and metals build everything from bridges to smartphones. Without these raw inputs, the system has no starting point. The real impact of commodities becomes clearest when prices spike. Higher oil costs don't just make driving more expensive, they ripple through the system. Shipping costs rise, airlines increase ticket prices, and grocery stores pay more to transport goods, which eventually reaches you at the register. Agricultural shocks work the same way. If droughts push wheat prices higher, the cost of bread follows. For households where food already takes up a bigger slice of the budget, these increases hurt the most. In both cases, you can see how commodity prices directly feed into general inflation, shifting everything from grocery bills to trade balances. Commodities really have two roles. In the real economy, they're physical resources: mined, farmed, drilled, and consumed. In financial markets, they're investment tools, traded through futures contracts, ETFs, or commodity-linked stocks. These are two entirely different uses, and mixing them up is one of the main reasons investors misunderstand how to handle commodities in a portfolio. Recognizing this distinction helps make sense of why the same raw material can be both a household cost driver and a portfolio hedge. The truth is, commodities are far from fringe. They shape price trends, influence inflation, and give investors a way to diversify in ways stocks and bonds cannot. Now that we see why commodities matter, let's sort them into the 4 practical categories you'll actually use when building a portfolio. Think of commodities as falling into 4 main groups, each with its own role in the economy and its own impact on an investor's portfolio. The groups are energy, metals, agriculture, and livestock. Seeing them this way gives you a simple framework to understand how raw materials move differently and why some are useful as protection, while others act more like growth signals. Energy comes first because it powers almost everything else: crude oil, natural gas, and coal fuel transportation, factories, and homes. Demand rises and falls with the global economy, and supply shocks can send prices soaring overnight. You'll often hear WTI and Brent when oil is discussed. These are the key benchmarks used around the world. Energy can bring opportunity, but it's also highly volatile, so it's not always the best choice if you're looking for stability. Metals divide neatly into 2 camps. Precious metals such as gold and silver act as safe havens and stores of value when uncertainty rises. Industrial metals like copper and aluminum, on the other hand, mirror economic growth because they are tied to construction, wiring, and manufacturing. Think of gold as wealth protection, while copper reflects how healthy the global economy looks. For investors, that split makes metals both a defensive hedge and a growth proxy, depending on which side of the group you focus on. Agriculture covers the crops and staples that feed people every day. Grains like wheat and corn, but also coffee, sugar, and cotton. Because food demand is relatively inelastic, people buy it even when prices climb. That makes agriculture a classic inflation hedge. When harvests are weak or weather disrupts supply, food prices climb and ripple through grocery receipts worldwide. From an investor's perspective, agriculture offers protection against supply shocks and inflation pressures that hit consumers directly. Livestock rounds out the four groups, including live cattle and lean hogs. These markets respond to feed costs, health outbreaks, and changing dietary preferences. While they draw less attention than oil or gold, shifts in livestock prices move directly into meat costs at the store, which means they also tie closely to household budgets. For investors, livestock exposure is another way to capture the economic importance of food systems, though it's generally more niche. The important point is that these groups don't all move in sync. Gold can climb while oil falls, wheat can surge while copper slows. This lack of correlation is what makes commodities a helpful complement to traditional stocks and bonds. Over time, gold and agricultural staples often help provide portfolio insurance. Gold because it's viewed as a safe haven in crises, and food commodities because necessity keeps demand steady even under price pressure. Knowing where each group fits lets you decide which exposure matches your investment goal, whether that's hedging inflation, balancing growth, or taking a tactical trade. The next question is how you can actually access these assets without large amounts of capital or dealing with futures contracts. Starting with just $100 is enough to begin building real exposure to commodities today. Many investors hesitate because they think this market requires massive sums, but that idea comes from the old futures-based system. A futures contract obligates the buyer and seller to transact a fixed amount of a commodity at a set date and price, which once required large margins and sometimes risked physical delivery. That setup was unrealistic for beginners. Imagine having to deal with thousands of barrels of oil or a warehouse full of wheat. The landscape is different now thanks to simpler tools. The most beginner-friendly option is the commodity ETF, or exchange-traded fund. ETFs trade on stock exchanges like any other stock, letting you buy into a broad commodity index or focus on a single resource such as gold, silver, or crude oil. Because you can buy one share, or even a fractional share if your broker allows it, $100 is enough to start. Still, it's important to check the expense ratio, tax treatment, and trading volume of any fund before you commit, since these costs directly affect your returns. ETNs, or exchange-traded notes, offer another path. They behave like bonds issued by a bank but are tied to commodity indexes. The catch is that ETNs are unsecured debt instruments backed by the issuer, which means they carry credit risk on top of commodity exposure. For investors who understand that trade-off, ETNs can be a straightforward way to mirror commodity prices without dealing with physical goods or futures contracts. You can also gain exposure indirectly through company stocks tied to commodities. Energy producers, gold mining firms, and agricultural giants often rise and fall in step with the resources they deal in. They won't move in perfect lockstep with raw commodity prices, but they give you a chance to participate in underlying trends without purchasing the commodity itself. For example, if oil prices rise sharply, an energy producer's stock may benefit more than the oil ETF, though of course, the reverse is also true. Physical ownership, like gold bars or coins, remains an option for those who want something tangible. The advantage here is that physical gold reduces counterparty risk, but the trade-offs include storage, insurance, and limited liquidity if you need to sell quickly. Many small investors choose gold ETFs instead, which are cheaper to trade and don't require a safe to hold your assets. So how does the $100 path actually look? Step 1. Open a brokerage account online, many with zero minimum balance. Step 2. Search for low-cost commodity ETFs or ETNs that fit your goals. Step 3. Check whether your broker offers fractional shares, since that can stretch your $100 further. Step 4. Review whether the fund tracks futures rolls or physical holdings, because that affects costs and performance. Step 5. Decide how much of your total portfolio to allocate, then make the purchase. If you want immediate practice, pause and search your brokerage for gold ETF, then check the expense ratio before buying. That simple action gets you hands-on experience. Here's the bottom line. Starting small isn't a barrier. The real decision lies in choosing the right vehicle that fits your goals and tolerance for risk. And once you see how even $100 can provide this kind of access, you begin to understand what commodities really offer investors. From here, the question becomes not just how to enter, but why commodities deserve a place in protecting the value of your money. Commodities aren't about chasing quick profits. Their real value is in the way they respond to inflation and add balance to an otherwise stock and bond heavy portfolio. 3 takeaways to remember. Commodities can hedge inflation and diversify your portfolio. You can start small, $100 is enough, by using ETFs, ETNs, or commodity-linked stocks. Always check costs, tax rules, and the risks specific to each vehicle before you buy. The same raw materials fueling your car, feeding your table, and powering your phone can also serve as a steady safeguard for your financial future. Be sure to assess your own goals and risk tolerance, and if you're uncertain, consult a qualified financial advisor. If this helped, like the video, subscribe for more investing breakdowns, and tell me in the comments which commodity you want to deep dive on.